my name is Hope Mindu, and I'm going to be taking you through the IFRS 10 Consolidated Financial Statements lecture. In this lecture, we're going to focus mainly on control, and the other part of this standard will be covered in future. So this lecture is going to come in two parts, and the first part will focus mainly on determination of control. So what are the objectives of this lecture? Okay, to start with, we want to classify share acquisition. Why do we need to classify? You could have a shareholding of between 1% to 100%, right? But then based on the shareholding, you have different rights, or a different level of power is attached to the percentage that you hold. We'll get into that. And we also want to look at the definition of control and actually apply it. So when you acquire shares, like I said, you can acquire shares anywhere between 0 to 100%, 0.1. But anyway, you're acquiring anywhere between 1% to 100%. And depending on the percentage that you hold, you have certain decision-making rights, or I could say you have some level of power, right? So I want us to just look at the different shareholding ranges and identify whether you have no power or you have some level of power. Okay, so let's say you go and you purchase a financial instrument. So a financial instrument, we're basically saying you've purchased something less than 20%, right? If you've purchased if you hold a shareholding of less than 20%, can we say that you can actually affect the decision making of an entity? Not really. Maybe you're just holding the shares to get capital appreciation, just for investing purposes, not exactly to affect the decision making of that entity. So if you hold 20% and below, would say that that's a financial instrument and it will be accounted for under IFRS 9. There's a mix of IAS 32 and IFRS 7, but you'll get into that in future lectures. And moving into the second circle, in the second circle, you are holding between 20 to 50%. The moment you're holding between 20 to 50%, okay, you can't really say you have power because you hold less than 50%, but then you sort of have some type of significant influence. You can actually influence decisions based on the way that you vote. So that IAS 28 applies to the second circle, and you're going to deal with it in the future. And then there's the third circle that says, okay, you're holding more than 51%. Okay, so if decisions over the entity that you hold 51% shareholding in are made through voting rights, we're basically saying you have the power in this entity. You have the power to make decisions. And that then links with IFRS 10, and we say, okay, you control this entity, and we then need to get into IFRS 10 to just define control. Because control goes beyond how much percentage you're holding. Okay, but then before we step on and we get into defining control and saying what is control, I want us to then look at how the circles are overlapping, specifically in the second circle and the third one, right? That point between holding more than 51% and holding between 20 and 50%, we're saying you're at a point where you're holding 50%. So you're holding 50% and another party's holding 50%. So we're basically saying you have joint control. You control together. You don't have the final say. You're actually, decisions will only be made in line with consultation with the other partner that you're controlling the entity with. Okay, so let's get into IFRS 10 and define what control is. And when you can say you can control an entity, that forms part of a business combination and you can consolidate. So what is control? I'd like to refer you guys to paragraph B2 and paragraph 7 of IFRS 10. So when you go through your standards, you're going to first go through your 1, 2, 3 up to whatever. So that's your normal text, and then you're going to have the B part. If you scroll further, so go there, you're going to find your B2. B2 defines control, and it says an investor controls an investee if it has all of the following, which means you need to have all of the criteria that we're going to go through. So make sure you take note of that. So you need to have power over the investee. Okay, so your standard then refers you to further standards to actually refer to determine if you have power. So you need to go to paragraphs 10 to 14 to determine if you have power. But in this recording, we're actually going to go through the definition of power and the application to say, okay, fine, do you have power? We're going to go through an example, right? Okay, moving on. You also need to look at, do you have exposure to variable returns, right? So an investor has control over an investee if it has exposure to the variable returns of an investee through its involvement with the investee, right? And we're also going to explain that further and get into it. And finally, you need to have the ability to use your power to affect the returns of the investee. So the investor actually needs to have the power to affect the returns. Okay, so let's get into it, get into defining the 3 criteria that we've identified and applying. So what is power? Power is defined in B9 of the standard, but you can also go to paragraphs 10 to 14 in your standard. Guys, make sure that you actually know where to find this information. Okay, so power is, you have power when you have existing rights and you have the current ability to use those rights to direct the relevant activities of an investee, right? So we then need to break down existing rights. What are rights? And we also need to break down current ability. Okay, so when can you say, okay, fine, I actually have the current ability? Then we're going to get into relevant activities. Say, okay, fine, what are the relevant activities of the entity, and do I have the current ability to direct those relevant activities based on the rights that I hold? Okay, so rights and current abilities. Okay, so IFRS 10 paragraph 11 identifies rights. So you could have rights in the form of voting rights, right? And you could also have rights in the form of contractual agreements with shareholders. That's where you say, okay, fine, you shareholders sit and say, okay, fine, the relevant activities of this entity are directed in this way. Maybe they are directed through the board or through an entity. So there's actually an agreement that says, okay, how are we going to make decisions on relevant activities? Okay, so with voting rights, usually in the absence of other facts and situations, if you hold the majority of the voting rights, we can say, okay, fine, you have power over the investee. But then there are other situations where you hold the voting rights, but you don't have power, or you hold less voting rights and you actually have power, I mean. So you're holding less than 50%, but you have power. We'll get into that in the second lecture. But for now, we're just going through the basics and saying, okay, what is power? Okay, let's go back. Let's define control. We're breaking it down. Okay, so relevant activities. So with your relevant activities, they're also defined in IFRS 10, in Appendix A of IFRS 10. And we say that relevant activities are activities of the investee that significantly affect the investee's returns. So how do you decide which activities significantly affect the investee's returns? You actually need to get to look at the purpose and the design of the investee. And IFRS 10 actually gets into the detail of how to determine which activities are relevant activities. And B5 to 8 says, okay, look at the purpose and design of the investee. Okay, so I'm saying the relevant activities of a manufacturing company and that of a venture capitalist entity are different. The relevant activities of these two entities can't be the same. You actually need to look at the purpose and design of each entity. So let's look at your manufacturing entity. Okay, so what are the activities that actually affect the returns of a manufacturing? It's probably going to be activities relating to operations, sourcing raw materials. Well, let's then contrast it with a venture capitalist. Maybe the person making decisions about financing ventures or sourcing the capital is the one that's making decisions that will actually affect the returns of the entity. So make sure that you actually break down the purpose and design of an entity when you're actually trying to determine activities that affect the returns of the investee, which in turn are relevant activities as defined, right? Okay, let's get into returns. So returns, you basically have to look at the investor. What is the investor getting from their investment into the entity? So if you're holding shares, what return would you get? You're probably going to get dividends, right? If there's a contractual, okay, yeah. So with shareholding, you're going to get dividends. And let's get into the link between power and returns. So now we're saying, okay, fine, do you actually have the ability to use your power to affect the returns from two? Do you have the ability to use your power to affect the amount of returns that you're going to get from the investee? So let's go back to our shareholding example. You're holding whatever percentage in an entity, say where you're holding 51%. So the moment you can use that 51%, you have the current ability in the form of you have the rights and you can use them and you can vote. So your vote, right, will actually affect the profitability of the entity. The decisions are either going to increase or decrease profit, and that in turn will actually then affect the amount of dividends that you're getting. So we can then say, oh, okay, fine. The moment you have 51% and you can make decisions, you can direct relevant activities, you're basically making decisions that are affecting the profitability of the entity. And in the end, that is actually going to influence the amount of dividends that you can get. So I want us to get into an example to see, okay, fine, can we actually apply the power definition? And then, the control definition, which is being split between power, returns, and ability to use power to affect returns. So can we break down the power definition? Can we identify the returns that we're expecting? And can we actually demonstrate how the investor has the ability to use its power to affect the returns of the investee? Okay, so let's get into it. Okay, so example 1, A Limited has 60% shareholding in X Limited, and decisions over relevant activities of X are made based on majority votes. So what is our question? Does entity A control entity X? So with control, we said you actually need to go through the definition and you have to meet 3 things. Okay, so what's the first thing that we need to get into? We need to get into power. Do you have power over the investee, right? And power is demonstrated when you have existing rights, 1, that give you the current ability to direct relevant activities, 3, right? So does A Limited have any existing rights to actually affect the relevant activities of X Limited? Okay, so the existing rights in this case are in terms of the 60% shareholding, and we can actually say that A Limited has the current ability to exercise these rights. Since they're holding them, they're theirs. They can actually vote based on these rights that they're holding, the 60% that they're holding. They're actually going to use to vote towards relevant activities. So now let's say, okay, so they can vote. So we've gone through. So now let's get to the portion where we're saying how the decisions over relevant activities made. All right, which is the last part. And decisions over the relevant activities are made based on majority votes. Since A holds 60% in X Limited, we can actually conclude that A Limited directs the relevant activities of X. So have we gone through the power definition and proved that A Limited has power over X? Yes, we have. Let's move on to the other things. What else do you need? Exposure to variable returns. So how will A be exposed to X's variable returns? The moment you hold shares in an entity, you're actually expecting some dividends, right? So they're actually going to have dividends. So they're exposed in the form of dividends. So we've covered exposure to variable returns. Let's get into the final element of the control definition. You need to have the ability to use power to affect variable returns. The moment that A gets any percentage above 51%, because X Limited's decisions are made based, X Limited's relevant activities are directed based on majority votes, we can say, okay, they have 60%. So they actually have the ability to make decisions over relevant activities. And the moment that they're making decisions over the relevant activities, they're basically affecting profits, right? So you're affecting profits and then link it then with, okay, fine, how then does it affect the returns that I'm exposed to? So you're exposed to dividends. So the moment you're making decisions over profits, you're actually then affecting the amount of dividends that you're going to receive. Your decision could either increase profits or decrease profits, and subsequently that actually increases or decreases the amount of dividends that you're going to make. Guys, we've gone through control. So at the end of this, I actually expect you to be able to apply this definition of control when you get into tests and exams. Okay, so here we're just dealing with the basic stuff. We're going to get into exceptions. So, you know, like at what point would you say that, you know what, voting rights, like on their own are not enough to make the assessment of control? There are other facts and circumstances that we need to consider. So just some advice in terms of answering tests and exams. You noted that we're actually highlighting the parts of the standard that you expect to find information in. So have like logical flow. Okay, where am I going to start from when I want to prove control? And then I need to move on to this and then that, right? So actually go tag in your standard the path that you need to take in your discussion. So you don't need to go tag B2, B9, B10 to 14. You could just go and start at B2. And then B2 refers you to all those other standards. So you don't then need to be flagging your standard on every part that is related to. You've flagged it based on the main concepts that refers you to other parts in the standard. So make sure you do that. Coolies, guys. Thank you.